The Everything Apartments podcast is provided with support from the Apartment Association of Greater Los Angeles, better known as AGLA, serving residential landlords throughout Southern California through education and advocacy. Visit aagla.org. Welcome to the Everything Apartments podcast. I'm your host, Eric.christopher, and on this podcast, we cover all topics of multifamily investments, from buying and financing properties, day-to-day operations and management, and also reinvestment strategies. Property insurance, or as many call it, fire insurance, has become a tougher and tougher topic for property owners, and we in the multifamily business are feeling the effects. Based on what I'm seeing in the management portfolio, renewals are coming in at much higher prices, to the degree of 25 to 50% higher on properties that have never had a claim. And I'm also told a lot of the carriers are starting to pull out from writing business in California. I'm sure most of us are in the same place. Like I said, we've never had a claim on the insurance that we carry. So what's going on? And more importantly, what we can do to minimize the effects on our income statement. In a moment, we'll speak with Paul Smith, a longtime insurance broker here in Southern California. His firm's actually called SoCal Commercial Insurance Services. And we'll try to make some sense of all this. But first, I'll tell you about our firm, WSC Realty Advisors and WSC Property Management. WSC has been helping buyers and sellers and managing apartment properties in Long Beach for over 16 years. Let's say you're tired of managing property yourself, or you're just not getting the reporting or the response level with the manager that you have in there now. We can definitely help. WSC never wants to be the biggest firm in Long Beach. Instead, we stay a little smaller and more agile to bring the quality you want. We can also help you if you're looking to acquire more units here, or maybe do an exchange scenario to an out-of-state market or something to that degree. Visit WSC-PM.com. Call, text, or email us. All that information is in the show notes, or certainly right over my shoulder if you're watching on YouTube. Mention the Everything Apartments podcast and get your first 2 months of management absolutely free. Whatever your challenge with your property, WSC has the solution. Paul, it's great to have you on the show today. Thanks for joining us.
Yeah, my pleasure, Eric.
So tell me, how long have you been in the insurance business? Because I saw that your father, like mine, and we talk about that in just a second, looks like you're second generation there.
Yes. I've grown up around the insurance industry, my whole life. I didn't actually join the industry until I had already had, one career prior. So it's been 20 years. I've been licensed since 2003. But yeah, I had a full other career in another industry prior to joining insurance.
So is it mainly a commercial focus you have there, or do you do both sides?
We are 99.9% commercial. We write a few personal lines policy as an accommodation. Our commercial clients get kind of spoiled by our one-on-one service and ask us to look at their personal lines, but the markets are a little wonky right now. And so we tend to refer people to agencies that specialize in personal lines for those policies, just because it's in their best interest. We specialize in commercial, and we feel like that's really where our sweet spot is, and where we can be at the most benefit.
And that kind of parallels what I was doing. I kind of did it backwards, as my dad's an old commercial broker, and then my grandfather was a surety bonding guy, and that's how my dad got into it. And I was a licensed broker when I was in college, and learned a whole heck of a lot. We were writing risks that were heavy construction, earth moving guys, and pipeline, and very interesting when you compare and contrast all the different kinds of businesses, the risk exposure and the premium structures and all this stuff. And then you kind of whittle it down to what we're talking about here today. And it doesn't seem like property insurance, when we kind of like move that toward looking at apartment buildings, it doesn't seem like there's a whole hell of a lot of moving parts with that kind of risk.
No, not at all. It's a very, very benign, easy risk, always has been. Traditionally, people would call us for an apartment building quote, and we could hop on a few websites and have multiple quotes within a day or two and get things bound and wrapped up very easily. Unfortunately, that's come to a screeching halt as of just over the last couple of years, especially. And right now is as bad as it's ever been, as bad as I've seen it in 20 years.
Yeah, and that's kind of pushed the urgency of having you on, because like you're saying, on your side of the provision of the insurance, is sort of a yawner, right? You just book the thing, and for the owners and managers out there, it was more or less the same thing. You kind of eyeballed the numbers about the same as it was last year. You didn't, you may go get a quote here and there if you're feeling like you had the energy or the desire, and then you'd find out, oh, okay, that one's a couple $100 difference, plus or minus. We'll stay with the one we have. But all of a sudden, like you're saying, yeah, 3 or 4 years ago, started to see this thing happen. Now, I've heard different things about why, but I'm going to ask you, because you're the expert. Like, what happened to the industry on something as silly as an apartment building? Like, most of the people listening to this never have had a loss, right? Or if they did, it was, something small, a dog bite or a tree smashed into something. It wasn't catastrophic. So here we are, the good kids on the block, not causing anybody trouble with claims, and whammo, here you go, here's your increase. What drove all that?
It's a perfect storm, if you will. It's kind of a confluence of events that are all coming to a head at the same time. It starts with the fact that everything ends up with a few major carriers at the top of the food chain that are reinsurers. For example, if Farmers writes a policy on a building for $1 million, Farmers does not keep $1 million in the bank to pay for that building if it goes down. Farmers charges a premium. They keep maybe $100,000 of that risk that they have reserves for, and then they buy insurance on the remaining $900,000 of that risk from Company B. Company B then turns around and they keep maybe $250,000 of that on their books, and they buy insurance on the remaining 650,000. The first dollar is the most likely to be touched in a loss, and so that's going to be the most expensive insurance dollar. As you get higher and higher into the value, on $1 million building, very unlikely to have $1 million loss. And so the last, couple $100,000 of insurance on that building are relatively inexpensive, except that, through a series of worldwide natural disasters, whether it's wildfires in California or floods, in Libya, or earthquakes in Morocco, these few reinsurers at the very top of the food chain, they're insuring all of this. And so as they start to get touched, and then they have to start raising their rates, and it moves down through the carriers until, finally Farmers is having to pay much more for the reinsurance than they used to, and they're having to charge you to make up that difference. That's one of the things that's going on. Another thing that's going on is inflation and increased cost of construction. Over the past it started, like you said, 3 or 4 years ago when you started noticing premiums going up. You probably also started noticing that carriers were looking to increase the replacement value on your building. And that's because traditionally, construction costs in Southern California had been, $100 a square foot, $125 a square foot, and nobody thought much about it. Everyone was kind of lax and not doing their due diligence into what it would actually cost to rebuild some of these buildings. And then after a couple large wildfires, when carriers had to rebuild things and it was costing them $200 a square foot, $250 a square foot, when they had been collecting premium based on 125, their reserves were short. And so now they've got to turn around, and in addition to the cost of the premium, the rates going up, they're also having to increase the rating basis, which is the cost of reconstruction. So you've got that as another factor. Now add in the fact that investors traditionally come to insurance because it's a safe harbor for their investment dollars. Well, the insurance industry has been under and losing money on their underwriting for the last couple of years. And so investors are no longer bringing capital into the market. Less capital means less reserves available to pay for losses. And so companies are pulling back what they're willing to insure and the amount of insurance that they can offer. So it's a whole bunch of things kind of coming together. And you add in the fact that the California legislature is very difficult in terms of allowing insurers to model, on risk factors, and that there, certain increases, capped increases in premium, regardless of what the reality of the situation is. The legislature is saying, okay, well, sure, you feel like you need a 30% increase will allow you to take an 8% increase.
That was going to be my question, because I have been with the latest round of renewals and seeing like a bigger number, call up. I've got like 3 that I've kind of used, and they're telling me, oh, no, stay where you're at. Like, it seems like Mercury's the one that I'm seeing that's still hanging around. But the roundabout question there, when you talk about the legislature, maybe, I don't know, the fire exposure here, because I've heard a lot of the carriers are pulling out of California, and I was wondering, what's the driver of that? Is it the regs, or is it the fires, or is it both? Because obviously, less supply equals higher prices, right? So
Right.
what would cause a carrier to say, we're not doing California anymore?
It is a combination of the higher risk of wildfires, and that's a whole different story about land management and fire mitigation, and a combination of the legislature not allowing carriers to take rate increases based on what they see as the actual risk in the state. And it's a political issue where they're saying, oh, we have to protect the homeowners, or we have to protect the property owners and keep these prices low. But by doing so, they're forcing carriers, because you and I both know, as business people, if somebody tells us we have to run our business and lose money doing it, nobody can do that. And insurance carriers are no different. It's not like anyone has all this extra money laying around to just keep paying and paying without being allowed to run their business and make a profit.
No, and that rings out, because it kind of, in my mind, kind of parallels rent control. And it's sort of like, I'm getting to the point with the government is I'm trying to figure out stuff that they do right at this point. And what they don't do right is meddle in supply and demand and let the free market decide, because after carrier A, B, and C leave the state of California, is that normally a permanent thing, or is that a cyclical thing? Like, yeah, we'll be back, we're going to go to this higher ground for a little while, but we'll see you later? Or do we lose them forever?
No, traditionally there have always been hard markets and soft markets in California, and in insurance in general. I don't know if you recall, a few years ago, you could not buy earthquake insurance on an apartment building in Southern California. It just wasn't available, period. This is maybe 12 years ago, 14 years ago. And then suddenly, after somebody, brought some capacity into the market, investors saw that, earthquake was a reasonable risk and they could make money by underwriting and collecting premium, and there weren't any payouts. Well, more capacity flooded in and the prices went down, and we had guys that had been paying $40,000 a year for earthquake. We're now paying $20,000 a year for earthquake. That's a big savings if your insurance costs are cut in half. That's changed now. Earthquake prices are going up. Well, same thing with the fire and special form. Now, we haven't seen this hard of a market since I've been in the industry, period. I haven't ever seen this level of pullback from carriers. I truly believe that it will be cyclical, and that these carriers will come back, and that the legislature will at some point, sit down and figure out, okay, what do we need to do to create a healthy marketplace that will, encourage competition and encourage participation. And once they do that, that should provide some relief and a break to property owners.
That's a good point, because you wonder, it's got to be lucrative, right? It's like a developer who has so many hurdles and expenses to build X units in Los Angeles versus somewhere else, Texas. I don't know. Once you make it hard enough, it's like water. It's going to find its easiest path to the highest ROI.
Mm-hmm.
So certainly these folks, that are leaving have a better idea in mind. But if they're not here, like, is there really a market? Like, just for something silly, and you probably have even much tougher risk classes than apartment buildings. Probably most of them are, with more exposure to loss. But like, is there a market right now, or are you hanging around? Because I know from my past experience with my dad, it was like your appointments meant everything. And the carriers you have, obviously, they're like bank lenders that will get super aggressive for a while, and they'll accumulate a book of business, and they'll go, okay, let's pull back a little now. So I guess the question is there a market right now, or you have one place to take the restaurant risk, you have another place to take the general contractor, is there competition, or is it just sort of a static right now?
There is a truncated market. There's a little mini market, if you will. You mentioned Mercury. Now, I think they're renewing things. I don't believe they're writing any new business on older apartments, but they are renewing what's on their books. There's a company that we work with that's part of the Berkshire Hathaway group, Warren Buffett and his, Guard and Berkshire Hathaway Direct. And there is one small company there that will write some smaller, older buildings, but they're very quirky. They're very picky. They won't write a whole ton of value for a single owner operator. They may write, one building for an owner, or maybe two if you're lucky, and they'll write it on the cheap. And then we've been seeing their renewals are coming in, 60% higher, 70% higher than the original, but it's still far and away better than anything we can get on the open market.
Yeah, I've noticed that. I have a building actually I own with my family that's with the Berkshire Hathaway, some affiliate of them, but I recognize the name, and it seems like the rest of them are Mercury, but I haven't seen a reason to switch in a couple of years now. Like when I go out, and I'm almost not doing it anymore, like source it out. And I've had this happen 3 or 4 times in this year. No, stay where you're at. We can't touch that. I remember when I was working with my dad, and this was the late 80s, that there was a real tough time for people to get workers' comp insurance for construction. And I don't know when it originated, but here comes the state fund insurance fund to cover what I was led to believe was sort of like, if you couldn't get the insurance anywhere else,
right,
that you could revert to basically a state organization. And then I understand later they turned into kind of a real business model. But getting back to like what we're talking about here, something as standard as like an apartment building fire policy and a business owner's policy thing, could there be a time when there's almost no place to take it?
We are approaching that time. We still have a few carriers in addition to the one Berkshire Hathaway affiliate that's an admitted carrier that will write some new business. The rest of the availability is coming from what's known as the excess and surplus lines market. There are carriers that they write on what's called a non-admitted basis in California. That sounds a little bit scarier than it is. They're licensed, they're fully licensed, they write legally in California, but they don't pay a fee to participate in the Department of Insurance Guarantee Fund, which is one of the requisites of being able to write on an admitted basis. Now, all of them are affiliated with huge companies that write on an admitted basis. For example, the Nationwide Group. Nationwide is on your side. Okay, they write on Nationwide paper. They write on Amco paper that's admitted. They write on Scottsdale is another one of their companies that writes on a non-admitted basis in California. And what it does is it gives the carrier a little bit of flexibility in not having to pre-file rates and being able to write things that are a little bit off the beaten path. And so all of the large groups have their both admitted and non-admitted affiliates that they write business through. So the non-admitted market is where we're seeing most of the capacity for apartment buildings, especially we're talking about older buildings, maybe with lack of verifiable updates to the major systems, electrical, roof, plumbing, because a brand new building, you can still get written on admitted paper, in a lot of different places. But we're talking about the 19, and let's face it, most of Southern California is 1950s, 60s, and 70s, frame with tuck under parking, non-sprinklered. And that's where the big problems are.
Yeah, Long Beach, you got a multitude of buildings built in the 20s and 30s. The one that I just suffered through the big price or cost increase was built, it's an old bricker built in 1910. There's very few, unless you're talking about the big new redevelopment stuff downtown, that's meeting that new, what I consider new for most of the stuff I work with and the owners that listen is like the new stuff is built in the mid to late 80s. Right. So it's not new to you as far as insurance goes, but certainly there are many, many hundreds of buildings out there that have had the same original electrical, most plumbing.
Thousands,
people don't,
tens of thousands.
Yeah, in Long Beach. most owners, they replumb a unit when they can, and the rest of it's the original say. So that's something I've noticed lately is the questionnaires are like, exactly what improvements have you done? And then that would be sort of a nice little segue into what can owners do? Obviously, we won't be able to do much, but that's probably one of the things that owners could do to like grease the skids just a little on moving forward those improvements, although they're quite costly. And I don't know that having an extra insurance market or two is going to entice you to replumb your building. It's probably not what I'm saying, but I guess more of an oversight on what's the best thing or things for an owner to do and say, okay, I'm going to renew my insurance in 6 months. Is there anything short of those great big improvements that they can do to make life a little easier, or no?
Not really. I mean, if you're talking about giving yourself the best opportunity to at least expand the number of markets that will look at your building, that's really what you need to be looking at. Is if you can't go out and show proof, either by showing copies of permits that have been pulled in the last 10, 15 years, which are all available online. One of the things you can do is maybe have a licensed contractor come out and provide an inspection report stating that I've looked at the electrical system for this building. It's in good working order. So you're not asking the guy to put his rear end over the line by saying, oh yeah, I guarantee this system isn't going to fail or cause fires. You're just asking someone to say, look, I've taken a look at this. It appears to be in good working order. And if you can have an electrician do that and a plumber do that, a roofer or an HVAC guy do that, it saves you the expense of having to redo these systems, and it at least provides some ammunition for your broker to take to the carrier and go, look, the guy is on top of it. He's having his stuff inspected, and here are the results.
That's an excellent idea. And it doesn't take a ton of out of pocket to do that. And it doesn't take that much time. So it's almost like, why not? And then, if you have like a third party inspector or a contractor, you may learn a few things that property manager doesn't quite understand or see, or some stuff that you want to proactively do. But that's kind of a good thing to give them a pitch on why your building's not just a rundown and under cared for asset to get maybe an eyeball or two, maybe a second quote, who knows?
Right. And it will make life much easier on your broker. Another thing is, if you have a broker that you like and you trust and you work with, stay with them. Give them the opportunity to shop the markets for you. Because what's going to happen is if they give you a quote and you go, oh, I don't like that, I'm going to turn around and talk to this other guy. If your broker is worth their salt, they're already sending applications out to the markets that are available. Now you turn around to this other guy and he sends applications out to the same markets. And maybe a third guy approaches you at an apartment owners meeting and says, hey, I can do this for you. And so you give him a chance. And well, now you've got underwriters at Scottsdale and underwriters at Westchester and underwriters at Berkshire Hathaway receiving the same set of applications for your building from 3 different guys or gals. And the underwriters are saying, oh, this guy's just shopping. He's not serious. That's going to go down to the bottom of my pile.
It's natural for people to want to approach a couple sources, but based on what you're telling me and what I'm hearing directly on the renewals is maybe not right now.
Well, I'm not saying don't get multiple quotes, but I'm saying don't have multiple brokers do it. Ask your broker, hey, who are you going out to market? Who are you quoting this with? Send me a list of the companies that you're quoting this with. And then you take that list and you turn around it. And if you want to give someone else a chance, you go, look, my broker is approaching these companies. Do you have anyone else? Again, if you are working with someone that you trust that they're doing the right thing and they are going to these multiple carriers on your behalf. I mean, that's what we're paid to do, is to be your advocate, to these insurance carriers. I don't write specifically for Farmers or specifically for State Farm. I write on behalf of you. And so I go and scour the market. If there's someplace I'm missing, well, then shoot, I'll give you a list of everywhere I've gone. And if some other guy says, hey, I can go somewhere else, by all means, have them go somewhere else.
No, that's a great idea. And it takes understanding that it's easy to forget like that a lot of you all have the same markets, and why clog up the system versus Farmers, State Farm or Allstate or something has your whole package with your home and whatnot. Those are single source agents, right? They don't shop outside of their brand. So
well, technically they're not supposed to contractually, but there are ways around things.
Oh, okay. So you may see
Yeah,
little of that
your
too.
farmer's guy may be able to go out and get some excess and surplus quotes as well. I talked to a wholesale broker the other day, and they talked to an underwriter at, I think it was Westchester. The underwriter said they were getting 35 new submissions a day, 35 new quote requests a day for one underwriter. That's 10,000 quote requests a year. Now, which ones are they going to look at? The ones that they think are serious and the ones that have the most and best information on them, the ones that are showing either proof of updates or proof of inspections that are evidencing systems that are in good working condition.
What do you think about AI taking over the underwriting process? Is that prone? Is that a target for that, you think?
Yeah, I think if you listen to the AI developers, everything's a target for AI. And we've seen over the last couple of years a lot of carriers attempting to sell virtually or sell directly, with very little human touch. I'd say that's probably a form of AI, maybe a little less advanced than what we're seeing now. But if you can go on to a website and put in a few keystrokes and get a quote back without talking to anyone, that means that there's either been a complete lack of underwriting or there's been some AI underwriting. Maybe I'm old or old school. You see that's the gray in your beard like I got in mine.
Got it there too.
I don't believe that AI is quite ready for the nuance that it takes to do commercial risk, even as something as simple as apartment building is a little nuanced and is becoming more complex, as we've seen from what's happening in the marketplace. I don't see AI as being the be all end all of this.
We shall see, right? I'm cautiously optimistic about what it'll do, but then we grew up at least close enough in age to see the Terminator, so there's always that in the back of our mind. Go circle back with you real quick onto that. I remember Dad's agency. A lot of the construction risks had to use the non-admitted offshore at times carriers that some of those were okay and others I don't know if they ever existed looking back on it. But all that ends up, the first checkpoint is the lender or in that case, it was the owner of the project, whether that be a municipality or it. But will they allow the search to fly? So most of us have loans on our buildings. Certainly, even if you didn't, you're going to want to have insurance. But when you have a bank like Chase that looks at the quality of the certificate, do you feel like the banks are going to have to relax their standard of saying in California it has to be an A-rated, admitted, et cetera, and go well, those are extinct now. You're going to have to accept a non-admitted carrier's paper, or is that already happening? Because I don't really know.
Well, the banks are not allowed to tell you that you can't have a non-admitted carrier. They have to accept admitted or non-admitted paper. But the way they phrase it is a carrier that's legally allowed to write in California. It leaves the word admitted out of it specifically. What they are allowed to do is to look for certain coverages, ordinance and law, boiler and machinery, maybe excess liability, that they're going to have to start relaxing their requirements on. And most of them will, in recognition of the current state of underwriting, because they recognize that it's either, the most insurance you can get or it's no insurance. Well, we'll take the most insurance you can get. And I have an example of that. I insure a building for a client, and it's located just kind of the few blocks down from what might be considered a brush area. And the replacement value on this building is maybe $6.5 million. Traditionally, we've insured it through either programs or in the admitted market, the $15,000, $20,000 range for the property insurance. Well, this year, as the poop hit the fan, only insurance we could get on this building was for a $2.5 million loss limit and $100,000 of premium. Now, we could have bought an excess $4 million for another $50,000 in premium. But the owner said, well, let's see, let's go ahead and we'll bind the $2.5 million. We'll send it to Chase and see what they say. And so far, Chase has accepted it. It's a $2.5 million loss limit policy because, and again, the odds of taking a 100,000 or $1 million or $2 million loss on this building are much, much higher than taking a full $6.5 million loss. So Chase, the banks understand that that's the majority of their risk is in the lower loss category. As insurance professionals, and we tend to run a little conservative because the cost of insuring the total loss is usually reasonable in comparison with, a loss limit policy. We generally suggest insuring against the total loss. I mean, that's traditionally what you want to do. In a market like today's market is, in some instances, like for this particular building, a loss limit may make sense. Like we've done, traditionally more on earthquake schedules. If I've got an apartment owner who's got 30 buildings, we've got earthquake on all 30. The values are $55 million. Well, we've got a $10 million loss limit on this policy because the geographic spread of the properties is such that, we don't think everything's going to go down in a single event. And so we look for, what seems like a reasonable value. Where's his highest concentration of risk? Okay, so if this entire area goes down, you've got 10 million of value there. Let's insure that, in full. And then if something else goes down over here and it's only 2 million, well, then it's about putting together the pieces in a way that make the most sense and mitigate the most risk without maybe covering all of it.
Different times and market conditions require different strategies. We see that with the lending changing or, government interference with rent control. So some of this stuff maybe like insurance, and then the way we didn't have rent control forever, decades and decades, it causes us to think differently about all this stuff, maybe behaving differently than we're used to. Well, Paul, let's leave it there. So I'm going to put all your information in the show notes so that somebody out there that has a question about insurance can call you. And just as a reminder, Paul does all different kinds of commercials. So I know some of you out there have restaurants and other, types of businesses you're running. Sounds like Paul's got all of them covered. Even if right now, maybe on the apartment buildings, he's going to tell you, like I've heard, stay where you're at for now. But as we've seen with everything in the market, whether that's lending, like we were talking about, or insurance, it changes. And as Paul was saying, hey, right now, maybe some of these carriers are running from the hills and not writing in California, but they may be back. And then a couple of years from now, Paul says, hey, we got this new market that came back and the prices are 20% lower. So a good guy to have in your Rolodex. And certainly, I'm sure he'd be glad to help you. Paul, thanks again for coming in today.
My pleasure, Eric. And just real quick, we are generalists. So yes, we do write all different types of businesses. We are particularly adept at apartment buildings, and restaurants, bars, and taverns make up a big part of what we do on a daily basis.
Thanks again. You've listened to the Everything Apartments podcast. I'm your host, Eric Christopher, and stay tuned for another episode coming soon.